Hello, Professor. My name is Yosit Tamnoya, and together with my teammate, Frank and Lindy, we are going to present a financial and stock performance analysis of Colgate Palmolive from 2020 to 2025. To begin, I would like to briefly introduce the company and explain its position in global consumer product industry. And now we're going to talk about a company overview. So Colgate Palmolive was listed on the New York Stock Exchange under the ticker symbol CL. It is one of the world leading consumer product companies. The company focuses on the four major business is the oral care, personal care, home care, and pet nutrition. Today, its products are sold in more than 200 countries and territories worldwide. And the company history began in 1806 when William Colgate established a starch, soap, and a candle business in New York City. And also another major milestone occurred in 1911 when the company distributed more than 2 million tubes of toothpaste and toothbrush to school and dental hygienists, it helping to promote oral hygiene awareness. And in 1923, the company was officially incorporated in Delaware and continued expanding internationally. Another important milestone came in 1930 when the Colgate Palmolive was first listed on the New York Stock Exchange. So, over more than 2 centuries, the company evolved from a small soap and candle manufacturer into the global leader in health, hygiene, and consumer products. Talk about business mix and market leadership. Now let's examine Colgate Palmolive business structure and competitive position. So, looking at the sales mix in 2025, oral care is the company's largest business segment, contributing around 44% of the total sales, followed by pet nutrition 23%, personal care at 70%, and home care at 16%. So the data shows that the oral care remain the core drivers of Colgate Palm Oil performance, and in addition to its strong sales mix, Colgate Palm Oil also holds a dominant position in the global oral care market. The company controls approximately 40% of the global oral care market, making it a clear market leader. Compared to its competitor like Protect and Gamble's hold about 70%, while Unilever account for around 8%. So together, the top three companies control approximately 65% of the market. After understanding the company business structure, it is important to examine the economic environment that influenced its performance. So between 2020 and 2025, the global economy faced several significant challenges. The COVID-19 pandemic disrupted supply chains, affected consumer behavior, and created uncertainty across the global market. At the same time, inflation increased in many countries, resulting in higher production and transportation costs. Rising interest rates, geopolitical tension, and currency volatility also created additional pressure for a multinational corporation. Despite these challenges, Colgate Palmolive demonstrates strong resilience. As a consumer staples company, its products remain essential purchase for a customer even during periods of economic uncertainty. The company also benefited from its strong global brand, extensive distribution network, and ability to pass some cost increases on to the customer. Looking toward 2030, Colgate Palmolive expected global conditions to remain challenging. To support a future growth, the company is focusing on innovation, digital transformation, AI, and sustainability initiatives such as recyclable packaging and carbon reduction. These strategies are expected to strengthen the company's long-term competitiveness and support sustainability growth in the future.
So now I will present the financial analysis of Colgate Palmolive from 2020 to 2025. First, let's look at liquidity ratio. First, regarding to liquidity, Colgate's short-term liquidity become weaker. The current ratio declined from 1.28 in 2022 to only 0.83 in 2025. And the quick ratio also dropped to 0.54. The net working capital also turned negative from 2024. So this means that like the current liability were higher than the current assets. Although these figures look so risky, they do not necessarily mean Colgate is facing a serious cash crisis. The company still generates more than $4 billion in operating cash flow. Therefore, the main issue is not operational weakness, but Colgate reliance on short-term financing and commercial paper. About the long-term solvency, Colgate has a highly leveraged balance sheet. The total debt ratio increased from 93.1% to 97.8%, and the long-term debt ratio rose to about 95% in 2025. The time interest earned ratio decreased from around 23 times in 2020 to about 12 times in 2025. Although there is a decline, it is still far above the common benchmark of 3 times, meaning Colgate can still comfortably cover its interest expense. However, this increase in leverage was not mainly caused by excessive debt growth. Instead, it was largely caused by a shrinking equity base due to aggressive share repurchase. So the key risk is not immediate insolvency, but reduced financial flexibility. Moving to access ratio, Colgate performs strongly in terms of operational efficiency. Inventory turnover stayed around 4 times per year. Receivable turnover was about 12 times, and the fixed assets turnover was around 4.3 times, meaning every dollar invested in fixed assets generated more than $4 in sales. The total assets turnover was also stable at around 1.25 times, showing that Colgate used its assets productively to generate revenue. The key strength here is strong operational efficiency. However, one weakness is negative net working capital turnover, which again reflects their company dependence on short-term liabilities. This creates a contrast. Colgate operate efficiency, but liquidity buffer is limited. About the profitability ratio, Colgate remained profitable, but the profitability weakened in 2025. Profit margin fluctuated from around 16.4% in 2020 and declined to 10.46% in 2025. ROA reached a peak of about 18% in 2024, then dropped to 13.1% in 2025. Although this decline, the ROA's level still relatively strong. The most noticeable point is ROE. ROE increased sharply from 244.78% in 2020 to 584.11 in 2025. At first, it's really impressive, but it's not simply that the company became much more profitable. The main reason is the reduced equity base caused by the share repurchase and high leverage. Therefore, Colgate profitability is still strong, but the extreme high ROE should be interpreted carefully because it's strongly influenced by financial leverage. About the 2-point analysis confirmed this point. Profitable margin decreased as assets turnover stays stable, but the equity multiplier increased sharply from 14.46 times to 44.74 times. Therefore, Colgate high ROE remained mainly driven by financial leverage. About the market value ratio, the PE ratio fluctuated from 23.9 times in 2020 to 29.7 times in 2025. This shows that the investor continue to value Colgate earning highly because of its stable brand, defensive business model, and reliable cash flow. However, the PS ratio declined from 6.7 times to 5.6 times, suggesting that the market became more cautious about sale-based valuation growth. The market-to-book ratio increased sharply 100 times to 313.5 times. This partly reflects Colgate's strong brand value, but is also affected by the reduced book equity caused by share repurchase. Colgate also has a strong dividend history, which is one of the biggest strengths. Colgate has strong dividend record with 63 consecutive years of dividend increase. However, the payout ratio increased 78.3% in 2025, while the retention ratio decreased to 21.67%. This means the company returned more earnings to shareholders but retained less for the future growth. Finally, about the evaluate growth rate, because Colgate pay out a large portion of its earnings, its internal growth capacity become weaker. The internal growth rate decreased from around 8.10% in 2020 to 2.91% in 2025. This means the company has a less ability to grow using only retained earnings. The sustainable growth rate also fluctuated sharply into negative in 2024 and 2025. However, this result is partly an accounting effect caused by Colgate's extremely high ROE and very small equity base. Colgate's growth is supported more by operating cash flow, debt financing, and share buybacks than retained earning accumulation.
老师好, I'm Lindy. I will be presenting Colgate Palmolive's CL stock performance and investment outlook. Let's begin with the technical analysis on the monthly charts. CL is currently trading at $87.80. It's almost flat again with its 20 months moving average light, indicate weak upward momentum. Look at other indicator. Channel is downward. MACD is slightly positive but slack conviction. Relative strength index RSI is in a neutral zone at 50.57. History suggests that RSI level around 37 to 38 have often signal oversold condition and attractive entry points. Trading volume also declines, and now the price is struggling around the $90.5 resistance level. If the price of stock break out above this level and also confirmed by positive MACD and breakout channel, it could open an upside target near $108.30. But for now, there's no clear signal for new entries. Please caution and patience. Moving to the weekly charts to see the midterm trends, we can see more clearly bearish. The current price at $88.57, slightly above the 10-day moving average line, with still within the downward trend channel. MACD is positive but weak, and RSI at 53 reflect a neutral to bearish sentiment. More concerning is Elliott wave pattern showing an ABC correction, which typically imply further downsides. Based on this pattern, the potential downside target zone is around support level 74.3, a significant drop from current level. So again, we recommend existing investors should hold and new entrant remain patient. Wait for RSI risk over zone level for stronger confirmation from weekly and monthly MACDs and moving average. Breakout above the trend channel too. Now let's see the fundamental picture. Colgate Palmolive stock performance over past 6 years can be divided into 4 phases. In phase 1, 2020 to 2021, is a pandemic year, so the demand for hygiene products rose steady gains. Stock price up about 30%. Phase 2, 2022 to 2023, is marked by sideways volatility due to inflation, supply chain issues, and rising interest rates, decreased 17.5%. In 2024, phase 3, the company broke out to all-time high, supported by margin recovery, strong earning, and growth in pet nutrition, peaked to 51%. Finally, phase 4 saw a correction of about 28%, driven by slower guidance, profit-taking, and valuation concern, with the PE index about 25 times. Another aspect we consider are systematic and unsystematic risk. CL has a beta of 0.3, making it a classic defensive stock. Its essential consumer product ensures stable demand even in economic downturn. However, some unsystematic risk effects on stock performance, like foreign currency exposure, with 80% of sale overseas. And the second is commodity cost volatilities. The third is intense competition, and the last one is the retailer concentrations. Overall, CLs with low beta highlight its defensive strength, but firm-specific risk, especially currency and commodity exposure, shape performance. It remains a stable, dividend-paying choice for conservative investors. Now let's examine how CL performed on a risk-adjusted basis compared to its industry peer, represented by P&G, Unilever, and Just Right. In return metrics, Colgate Palmolive delivered arithmetic returns of 0.5% and geometric return of 0.39%, so a good return compared with peers. As the risk-return scatter plot, CL position at higher return, lower risk compared with peers, and also a combined view of standard deviation and Sharpe ratio indicate that CL delivery a best risk-adjusted performance. This is an idea for conservation investor with strong stability, low volatilities, and competitive returns. And is Colgate Palmolive stock undervalued or overvalued? We apply the simple moving average methods using 6-year average of PE and EPS to calculate. The mean PE is 28.3 times and the mean EPS is $2.79, giving a forecasted 2026 price at $78.96. Now comparing this to current market price, CL closed at around $88, significantly higher than our forecasted value, approximately 11 to 12% overvaluations. Therefore, the combination of downward technical trends and fundamental valuation below current level lead us to conclude that CL is overvalued at present.